This is the second part of our examination of the different forms in which a business may be incorporated. So we've talked about sole proprietorships and partnerships. We now move into corporations. Corporations is a term that's often used to just describe a business or a company. But a corporation has a specific meaning under state law. There's not a federal law that creates corporations or says what must be done to create a corporation. Rather, this is a function of state law. The same is true for sole proprietorship as well as general partnerships and all the other forms of partnership that we talked about. All of those are creatures of state law. So with corporations, the distinction between a corporation and a general partnership and a sole proprietorship is that the corporation is recognized as a separate legal entity. It's not synonymous with the owners of the business. The corporation is recognized as its own independent legal authority that can make contracts, that can have bank accounts, that can execute contracts, that can own assets. It's its own entity that can be subject to legal liability. So as a corporation, it's usually formed through what's known as a corporate charter, or it's oftentimes referred to as the Articles of Incorporation. This is a document that is completed that defines the purpose and the powers of the corporation. Usually the purpose is defined in a broad sense in terms of something like to conduct any lawful business. And so the reason is that if you have a company that starts out doing one thing, it's possible that they may start into another line of business. If you say that we're going to own and operate only the pizza restaurant that we talked about with our examination of sole proprietorships and partnerships, if you create the charter and you say we're only going to operate a pizza place, and then you instead branch out and begin a new restaurant that focuses on selling hamburgers. In that instance, then you technically are outside the scope and purpose of the corporate charter. That's why charters are usually written in a broad sense to allow the organization the freedom and the flexibility to be able to engage in any form of real legal business. So in a corporation, you have shareholders. These are the ones who are, it's the term that's used to define the owners of the corporation. So in partnerships, you have partners. In corporations, you have shareholders. So in a corporation, the typical structure is that the shareholders are the owners of the corporation, and then the board of directors is the executive body of the corporation. So it's the body that has the authority to make the big picture decisions. Then the board of directors, they give authority to officers like a chief executive officer or a chief operating officer, a president, and those are the officers that are hired to run the day-to-day operations of a corporation. And another important feature of corporations are that they are perpetual, meaning that corporations have a life that extends beyond the death or incapacity of key owners. Or if a key owner, majority shareholder, sells all their stock and gets out of the corporation as its own legal entity is going to live beyond that person. So the primary advantage that a corporation offers that a partnership or a sole proprietorship don't offer is limited liability. As we talked about, sole proprietors as well as partnerships, the owners, their personal assets are at stake. If there's a liability or a debt, whether it's a tort or contract-based liability, the assets of the owner may be used to satisfy or to pay that debt or the legal liability. In the instance of a corporation, though, the shareholder has no liability beyond their initial investment. And by saying they have liability to the extent of their initial investment. It just means that if the company were to lose all of its assets, then the shareholder is not going to have any value left. Their investment is going to be gone. So there's limited liability for shareholders in a corporation, which is a major benefit. If there was the example that we've used of the pizza restaurant, if that restaurant, you had the person fall and get hurt and they got, I think we said $100,000 judgment, in that instance, that $100,000 judgment would be paid out of the corporation. If the corporation only had assets of $50,000, then you stop there. They're only going to recover $50,000. They're not going to be able to go after the assets of the actual shareholders. That's different than the sole proprietorship or partnership examples that we talked about. So the exception on this limited liability is that the personal assets could be available if you are able to pierce the corporate veil. And that's a legal term of art that means when you go by saying we pierce the corporate veil is what typically is being used as what's shield, the limited liability that protects you and shields you as the shareholder. If you pierce it, the idea is that you're going through that veil and able to then go after the assets of the shareholder. So piercing the corporate veil is something that is somewhat difficult to do. It's limited. You can't just decide, I want to pierce the corporate veil. Because if you did, then there's no benefit of a corporation. You would lose the benefit of limited liability if it was easy to pierce the corporate veil. So this creates an exception to limited liability. If you're able to pierce the corporate veil, then the shareholders will be held personally liable for the claim against the corporation. Normal circumstance, the shareholder has no liability. Any claim would be satisfied by the assets of the corporation. If you pierce the corporate veil, then a shareholder can be held personally liable for the debts or liability of the corporation. So even if you believe you have an argument of piercing the corporate veil, there's no need to pierce the corporate veil if the corporation has sufficient assets to pay the liability. So in the example of our person getting harmed and getting a judgment for $100,000 against the pizza restaurant, if the restaurant has $500,000 worth of assets, then there's going to be no reason to pierce the corporate veil because the corporation, the restaurant, can pay the liability. The piercing the corporate veil only comes into play when the corporation has insufficient assets to pay its debt or liability. So piercing the corporate veil, there are two primary theories that are recognized. The first is the alter ego theory, and this is where the owner is using the corporation really as their alter ego. So you've incorporated and you've checked the boxes and done the right things that needed to be done with the state to have a corporate entity. However, there's really not much difference between the corporation and yourself. You're using the corporation by commingling your affairs with the affairs of the corporation. So you lack that separation, that distinction between the shareholders and the corporation. So a big hallmark of the alter ego theory is a lot of times you're commingling the assets. So you've got where you're using the same bank accounts. So you're paying your personal debts as well as the business debts or obligations out of the same bank account. If you're doing that, that is a good example of the fact that you're using the corporation as your alter ego. And so when you have this alter ego theory, then there's not that separate or distinction between the corporation and the owner. In that sense, it makes it possible where you can pierce the corporate veil and go after and hold the shareholder personally liable. Now, the other form of or theory for piercing the corporate veil is the undercapitalization theory. And this is where you, again, did all the right things in establishing a corporation under state law. But when you created it, you intentionally did not fund the corporation with sufficient assets, and usually is done for the purpose of avoiding substantial liabilities. So if you're doing something and you know it's risky and you decide, well, I'm going to incorporate and I'm going to protect myself from the liability, but I'm only going to put $10,000 in the corporation when it may need $100,000. That may be an example of where they can argue that you undercapitalized the entity, and that would give them um, a basis to argue that they should be able to pierce the corporate veil and go after the shareholder to satisfy any debt or judgment they may have. So oftentimes you may see a combination of this alter ego and undercapitalization theory, and there are different characteristics or traits you look for to help establish the alter ego theory or the undercapitalization theory. The bottom line is that usually when you seek to pierce the corporate veil, there is some form of wrongdoing or bad faith by the owner. They may have done the right things in setting this up, but it was done for a wrong purpose to avoid liabilities because they undercapitalized it, or it was done and the owner is using it as really a means to protect themselves, but there's no distinction between the corporation and the shareholder. So you usually will see some form of wrongdoing or bad faith by the owner in these instances in which you seek to pierce the corporate veil. So when we talk about corporations, there are two main types that we talk about. You have C corporations and S corporations. And the C and S, those designations come from the Internal Revenue Code. So subchapter C is the Internal Revenue Code section that deals with taxation of corporations. The S subchapter is the one that was developed to cover taxation of S corporations. And so you have C corps and S corps, and the default rule is that businesses are C corporations because, as we'll see in the next slide, S corporations have to meet certain characteristics. And if those characteristics aren't met, or if you fail to continue meeting one of those characteristics, then you automatically are qualified as a C corporation. So if you don't meet all the requirements or do the right paperwork to be a S corp, then you're automatically a C corp. And the main distinction between a C corp and an S corp is taxation treatment. If you'll notice, when we just talked about corporations, we talked about a lot of characteristics, mainly the limited liability aspect. But we didn't talk about how a corporation is taxed, and that's because there are two types of corporations, and they're both taxed differently. So you have C corp and the S corp. So before we talk about the taxation, here are the requirements to be an S corp. So to qualify as an S corporation, you have to be a corporation that has less than 100 individual U.S. Citizen or resident shareholders. So you're limited to the number of shareholders you can have. S corps are typically smaller organizations, something like Amazon, Apple, Google, all of those are C corp companies. They're not going to qualify for S corp because they have way more. They've got hundreds of thousands, if not millions, of individual shareholders. Also, to be an S corp, you can only have one class of stock. Those big companies like Google and all those have multiple classes of stock. It also has to be a company that's domestic, so you can't be a company that's doing international business or have an international presence. You've got to be a domestic company. You also have to file a timely election that's signed by all the shareholders. And when we say an election, that's a document in which everybody confirms that they're electing, all the shareholders are in agreement that they want to be an S corporation. And then the last requirement is that you not be an ineligible corporation. There are some corporations that the IRS has deemed ineligible for S corp status. And an example of some of those are insurance companies and financial institutions. Those are ineligible to be an S corp. So if you qualify for these and you meet all these, then you would be an S corp as long as you did the right paperwork and followed the right steps. But if you don't meet one of these requirements, or if you do meet it initially, but at some point you get more than 100 shareholders, if you take on new ownership and you've got 105 shareholders, then you no longer qualify as an S corp. And then at that point, you're automatically reclassified as a C corporation. So I said the main distinction between a C Corp and an S Corp is how they're taxed. So S corporations are taxed like a pass-through entity. That's what we've been talking about when we've been looking at partnerships and sole proprietorships. A pass-through entity means that there's only one level of taxation. Any profits flow through to the shareholder or to the, yeah, in this instance, shareholders, but when we talk about partnerships, it would flow through the partner, and any income tax that's paid would be paid based on your personal income tax return. So the money earned by the company, the profits, are only taxed one time. The S Corp, like a general partnership, is not going to pay any tax on those profits. It's only going to be paid by the shareholder. So in contrast, C Corps have double taxation. That means that the corporation itself pays income tax. So as the separate legal entity, a C Corp is going to have to pay tax on the income of the corporation. So they're going to file a tax return just like an individual would. But then the shareholder is also going to be pay tax on any income that's distributed to the shareholder. So if the corporation has money, if they've got $100 million, then they're going to pay income tax on that $100 million. If they then, at the end of the day, after they've paid the tax on that, they distribute $20 million to their shareholders, then shareholders are going to pay tax on that $20 million that's distributed to them. So that $20 million was taxed at the corporate level, and then once it was distributed, it was taxed at the shareholder level once it was reported on their individual income tax. So you can see a big disadvantage of C Corps is the double taxation. The income is taxed at both the corporate level and then at the individual level upon distribution to shareholders. So now that we've talked about the C Corps and some of their primary distinctions and advantages, let's talk about limited liability companies. And limited liability companies, just like all the ones we've talked about, are a creature of state law. So in forming these LLCs and drafting them, states have tried to create, take the benefits of both the partnership and the corporation and meld them together. So the treatment of an LLC is a hybrid really between a general partnership and a corporation. And they're designed to offer the best features of each form of business organization. So from the corporation side, the big benefit that we had is that the LLC will have limited liability. Corporations have limited liability. The shareholders are protected from the liability. The liability, unless there's a piercing of the corporate veil, stops at the level of the corporation. So if the corporation can't pay the liability or the debt, then that's it. You don't go after the individual owner unless you pierce the corporate veil. So in an LLC, they bring that characteristic. In an LLC, the members are not personally liable for the debts or liabilities of the corporation or the company. The only time that a member would be personally liable is if the corporate veil is pierced. From the general partnership, you bring the benefits of flexibility in drafting your operating agreement, and then you also get the benefit of single level taxation. We just talked about the double taxation that happens at the C Corp level. Well, with an LLC, the LLC pays no income tax. All income flows through to the member who will then pay tax on their personal tax returns. So you avoid paying tax twice on the income generated from the company. So this is definitely a melding of the benefits from the partnership of single level taxation with the benefit of a corporation giving you limited liability. So I already mentioned this, but an LLC is a creature of state law, so it may vary from state to state. An LLC, you form it by following appropriate paperwork, just like you would do for your corporations, as well as some forms of the partnerships. You have to follow the appropriate paperwork with a state agency. LLCs, similar to companies, corporations will use a charter or an articles of incorporation to define their purpose and powers. And then they'd have an operating agreement, which is similar to a partnership, that would define the rights, obligations, and powers of the members. So the members will then elect managers, which are functions similar to a board of directors, and the managers will be responsible for managing the business. This is from the big picture view. Managers will then select officers who will be responsible for running the day-to-day operations. So you may think about it and you see some of these benefits of an LLC, and you may think these are really similar to the benefits of an S Corp. And you're right. With an S Corp, you get limited liability, and you can agree to have pass through single level taxation. But the benefit between an LLC and an S Corp is with an LLC, you don't have to meet all the specific requirements to qualify as you do for an S Corp. For the S Corp, you'll remember we had all those requirements, like you couldn't be an ineligible type business, such as being a financial institution or an insurance company. There's a restriction on the number of members that you could have. So in an S Corp, you could not have more than 100 members. And there are even more requirements, but you had to have those requirements met, and you had to continue meeting those to keep your status as an S Corp. In the LLC context, you can have 15 members or you can have 500 members. So if you had a company that had 500 shareholders or 500 members, you would not be eligible for an S Corp, but you would be eligible for an LLC. So the main benefit of an LLC is that you don't have to meet all the restriction requirements, nor do you have to continue meeting those to keep the benefit of single level taxation with limited liability. For that reason, LLCs have become a much more favored type of legal entity to create your business with. You see many more LLCs created nowadays than you do C Corps or S Corps. LLCs have become the current favored business organization form. Now, we said that we talk a little bit about PLCs, and that's just a professional liability company, and that's one where you'll remember we talked about limited liability partnerships. This is similar to that in that it's professional organizations that have limited liability. So they have the characteristics of an LLC, but it's for professional companies. And the examples we used before, and these apply to the PLCs, would be a law firm or an accounting firm.